Hi there, I'm Rick Masnick with Network Funding, and I'm coming to you today with a message about credit scores. There are plenty of ways to monitor your credit score nowadays. You've got sites like Credit Karma, or if you've got a credit card with Discover, Chase, or Capital One, you're getting a score on your monthly statement. But are you getting the score that's going to be used to qualify you for a mortgage when looking to purchase a home? See, what many consumers don't know is there are a few different credit scoring systems. You've got your FICO score. Fair Isaac and Company is what that stands for. You got a FICO 8, and then you've also got one called the Vantage score. Now, the Vantage score is the one that you see when you're looking at a site like Credit Karma. Your FICO 8 is a score you're going to see when you look at your credit card statement, like with Discover. But your FICO score is what a major lender or mortgage provider is looking at when qualifying you for a mortgage. Having a mortgage provider look at that ahead of time before you go shopping for a home is a good idea because A, it's going to tell you whether or not you qualified for a mortgage. As a result of that score, you'll find out what interest rate you're going to be getting, but you should also be able to see what opportunities exist to increase your credit score, therefore lowering your interest rate. It's not just late payments that affect your credit score. It's the way you utilize your credit. For instance, if you've got a customer who has a $5,000 credit card and their balance is $4,900, they're almost maxed out on that card. Their credit score is probably going to be lower than another person who's got a $5,000 credit card, but their balance is only $2,000. They don't look as quite a risk because they're not maxed out. So it's a good idea to take a look at those things. And if the resources are available, you can pay that credit card down, have your score go up, and get a better interest rate. And don't be fooled by people who will tell you that having your credit report looked at by too many people is going to lower your credit score. See, the major credit repositories, which are TransUnion, Experian, and Equifax, the algorithms in their computer systems were designed to allow a borrower to shop for a mortgage to get the best rate possible for the home they're going to live in without being penalized for it. So when a mortgage provider runs your credit report, they're pulling something called an RMCR, Residential Mortgage Credit Report. And the inquiry on that is not going to affect your score the way a credit card or a car loan inquiry will affect you. You could have up to 12 different mortgage providers pull your credit report in a 2-week period and it won't hurt your credit score because ultimately you're going to end up with one mortgage. You could end up with all 10 or 12 credit cards if you apply for that many on the credit card side. So go ahead and have a mortgage provider look at your credit report. Here at Network Funding, we're going to analyze that credit report, look for opportunities to improve your score, get you a better mortgage rate, and ultimately get you the lowest payment possible on your home. So that's your Mortgage Minute for this session. I'm Rick Masnick with Network Funding. Take care.